Well, nat gas has a problem because right now with El Nino out there, it looks like this year we're going to have a slightly warmer, probably even a very warm winter on the East Coast, and that's going to put demand down on as far as nat gas is concerned. So right now you've got nat gas, what, 225 at one time this morning per million British thermal units. I think it bounced up a little bit more than that later in the day. 202, actually. I said 225. I meant 202. It got up a little bit higher than that at one time later this afternoon, but the trend is clearly downward. The weather continues to be extraordinarily good. We're probably going to be 1 or 2 or 3 degrees warmer this year than last year, and if that happens, as long as there's no shutdown continuing in production, you might, just to do it, put a one handle up on nat gas. That's hard to believe, but we might well get there.
Holy smoke.
Not quite yet. Alibaba did have good numbers. This is a quarter where they really started caring about the shareholder. Monetization rates were up, margins held up, they bought back stock, they communicated during the quarter to assure investors that everything's okay. But the really important underlying metric, which is volume growth, went down to 28% from 34% the previous quarter and 50% a year ago. The Chinese consumer is slowing down, so is Alibaba's volumes. However, they did deliver a very good quarter. I'd say that the stock is where it needs to be now. There was too much hype at the beginning. They were growing at unsustainable rates. Then everybody got too discouraged as the growth slowed down. And now as they stabilize at these 25-30% revenue growth, slightly less on earnings growth, they're trading at the mid-20s on earnings, and that's about a fair multiple. And they've become more of a clean play as a very good, fast-growing company that's tied to the Chinese consumer. So I think they're...
In the last 12 months, Apple's grown at about 30%. But if we look forward, Apple's expected only to grow its top line single digits. So you compare that to Alphabet and Amazon, who are growing strong double digits. That's the reason. The fear is that Apple is entering growth purgatory. It had the great last cycle with the iPhone 6. The fear is that smartphones are an increasingly mature marketplace, particularly at the high end. That's almost all of Apple's earnings and growth. And accordingly, the worry is that Apple won't really grow going forward. And as a result, it deserves a lower multiple relative to those other names. I think its best days are behind it. It's not going to be growing at 20 to 70% going forward. But its valuation is saying that. Ex cash, the stock is trading at about 7.5 times free cash flow. And what that means effectively is that the street is discounting that Apple's free cash flow will decline in perpetuity at 5% per year going forward. And that just seems overly pessimistic to me. I think Apple...